Great to see you, Aum. Great to have you on the African Allocator podcast.
Hey, good afternoon. How you doing?
Yeah, good. Really good to have you. Aum is an investment professional working for TLG Capital, a London-based private credit investment firm that works with various African companies. We're going to hear more about specifically what sectors, what types of companies you work with, but really great to have you on the podcast.
No, thank you so much for having us. I think it's really wonderful to connect, so appreciate it.
That's great. First question, what got you into investing? Just tell me a little bit about your story.
Yeah, no, it's a good one. I think that was, I suppose there's two questions, right? What got you into investing and what got you into Africa? Mm-hmm. For me, I mean, my father was born in Kenya, right? So my dad's side of the family is sort of that Indian, Kenyan, East African business community. My mum's from Mumbai, and they met in India. But yeah, I think when I was sort of studying at university, part of my degree is politics. I was doing the politics of Africa and South Asia. I was always really drawn to the Africa side of things. It seemed like a part of the world where when you look at the penetration of private capital or credit or any of these metrics, it's far lower as a percentage of GDP than when you look anywhere else. I mean, if you look at private credit as a percentage of GDP in the States, you have it as over 100%, right? Because of syndication and all these sorts of things. And so I think not only the fact that, like India and South Asia, many African countries have these recent stories and lived experiences of, becoming independent, right? So for me, my grandfather experienced what it was like to go from British India to independent India. When you go to Nigeria, Ghana, you meet people who've had those experiences. Of course, in some parts of the world, like South Africa and Mozambique, this is like our parents remember that, right? It's much more recent. But I think the concept of, countries trying to forge their own path, that as well as the modern sort of political economy was something I found fascinating. There's a book actually that Atul Kohli writes, and it's the first book that normally they throw in front of you if you go to like Kennedy School and Harvard and all these places. And it compares the difference between, I might get this wrong, Brazil, India, Nigeria, and Korea, from effectively the early 20th century, early mid 20th century, when all of these countries are the same GDP per capita, all the way through to today, where the outcomes are vastly different. And so I think that was one of the readings that my tutor on the African politics side threw in front of me. And ever since then, it was like, well, how do I get involved?
That's great. So you currently work for TLG Capital. The firm is a private credit firm, private credit, private debt. What do you guys use? What particular phrase?
So look, I think the firm, I love it. I think, we've got two key founders, Isha and Zain. So they're former bankers, started TLG in around 2008, 2009, seeing an opportunity like, The Economist, front page, Africa Rising, all these sorts of things of deploying private capital into Africa. Our first few deals were more on the private equity side, actually. We built one of the largest indigenous HIV and malaria drug manufacturers in Uganda. Took that all the way through to IPO. But then, you realize once these things start trading, that liquidity is really limited. Yeah. Whereas in the States, the great driver of private equity returns over the past 2 decades has been financial leverage more than operational leverage. That doesn't really exist because you don't have these sorts of lending structures set up for entrepreneurs or for acquirers. And then you have currency where, Nigeria, Ghana, Kenya, Rwanda, all of these markets have seen 20, 30, 40% devaluation in the past 18 to 24 months. And so I think the firm's sort of decision to become a private credit fund actually happened a while ago. It happened nearly 10 years ago in 2016 when we set up our first private credit fund. It was anchored by commercial investors because unlike many other, firms in Africa, we're really seeded by commercial capital. And so there the idea was more, you don't want to go to New York or Dubai or Monaco or Singapore and look your investor in the eye and be like, hey, I've lost your money. And that was the best way to do that. Well, to be structurally senior, to write loans instead of minority equity checks, to make sure you have a form of security and to be obsessed with downside protection and to try to structure your way around backing good entrepreneurs. And it turns out that entrepreneurs in Africa also really like that because they don't get diluted.
Mm-hmm.
So instead of having a minority equity investor that sits on your board, that seeks an exit after 5 years, that maybe is not aligned with your plan that you're building to hand your business over to your kids, the idea is very much, why don't we give you the capital, let you build what you need to build, support you on your way to doing that, and then naturally wind down or do another deal.
Mm. We're gonna get into that. It sounds very juicy already. But just sort of zooming out a bit, private credit as an asset class, if you want to call it that, globally is relatively young. Obviously companies like Oaktree have been doing that kind of thing for many, many years. But in the last few years, we've seen companies like BlackRock, make some huge acquisitions and stuff. But within the African space, it's much, much more nascent. So could you give us a sense of just the African private credit landscape? What does it look like today?
For sure. I mean, I think, you've got also the difference between local and international, right? So locally, let's start at the most basic level. Who's making loans?
Mm-hmm.
Well, I guess banks. But at the same time, if you're a bank, you can get cheap deposits and invest in government debt and make a nice spread. And that allows you to pay dividends and do your thing. And to be honest, you're systemically important, right? And so you probably shouldn't be taking too much risk because you're looking after people's mothers and grandfathers and parents' savings because they keep them in the bank. Outside of that, the big driver of a lot of the firms that you've mentioned, the alternative asset managers in the States, has been the traditional LPs, the traditional investors in the alternative space, who are mainly insurers, pension funds, long-term liabilities. Now, on the continent in Africa, you have, for example, if you look at Nigeria, there's data that PENCOM, who's the sort of pension commission, puts out every quarter as to where is this 30 trillion naira, which is like $10-20 billion. It's a huge amount of money. Where is that actually going? And you'll see that 70-80% is going to government bonds. And when it comes to alternatives, there's about 6.7% in, infrastructure and private equity and all these sorts of funds. There's 7%-ish in the stock market. And there was basically nothing in private debt until about a year or two ago. We launched with FCMB Asset Management, the first Naira local debt fund.
Mm-hmm.
And so I think it's like with anything, private credit it's an issue of supply and demand. You may have lots of people that want to manage the strategy because you can create good returns, because you're not correlated with private equity as much, because you have an exit, etc. But if the enabling conditions, i.e. local investors, are not willing to back you, then you have to go back to the international investors, who mainly are development finance institutions that potentially for the last 5 to 7 years has seen more impact in a private equity investment where you sit on the board and you can directly influence the day-to-day operations of a business, because their priorities are multivariate and not necessarily just about the best risk-adjusted return. They're also about how can you make sure that the right people are being employed? How can you make sure that meaningful employment is being created, that impact is being done, etc. And sometimes you need that sort of fiduciary perch of sitting
mm-hmm.
on the board or being the shareholder or having some teeth there to do that, which I also think is a bit counterintuitive because creditors normally have extensive rights that if you don't agree to, you're in default. And so I think that realization has happened probably over the last few years in the general Africa space.
Mm-hmm.
And so you have a number of smaller private managers that make sort of medium, small loans. You have a number of people in the fintech space. You have a load of people on the other side of things doing, buying Benin's Eurobonds or Senegalese debt or Angolan debt or Nigerian debt. I mean, the issuances from African sovereigns have been huge at that level, and then probably not that much in between. And that sort of mid-market is where we're looking to play. There are other firms out there, but we also believe that, that there's room for everyone really in this market because the market is just so big.
Let's talk a bit more about TLG's thesis. So could you just unpack that for us?
Sure. I mean, look, our thesis is in many ways very simple, right? We want to put our investors' money down into good investments and not lose it. And we believe if you do that often enough, and if you do that regularly, and if you do that over a long-term horizon, the upside normally takes care of itself. As you can see, even in public markets in the States, returns in the medium to long term are way more driven by drawdowns and substantial drawdown events than they are necessarily as to whether you're making 11 or 14% year on year. If you lose 20% because you're exposed to high volatility, that's where you're not compounding wealth in the long term. And so our strategy has very much been to identify and partner with the best possible African entrepreneurs that we can find. And this is where, when you sort of speak about how we source our deals, which we might do later, and all these sorts of things, it's not like we go to a conference and say, hey, do you want some money? We originate through the banks, or we originate through local partners. And that means that we find that company 6 hours outside of the city that no one might go to ordinarily, because there's not in the nice hotel or the airport lounge or wherever it is that you may travel if you're going to Africa for business from London or New York or Paris, etc. So identify great entrepreneurs, come up with awesome structures. I think when you look at our team, everyone's come from sort of structuring or that kind of background where beyond the fundamentals, is the company good? Are they in a nice market? What are their margins like? Do they control costs? Are management good? The focus is a lot more, well, if things go bad, as they might when you're investing in frontier markets where macro is very volatile, how do you get your money out and how can you make sure you can exit? So we really try to protect our investors' interests and we really look out for the downside. For example, we did a deal 2 years ago with a Nigerian film producer who makes movies. The way that we did that deal is we found some sort of receivables that we could discount that was contractual income coming in, instead of a vanilla package where we take security over the business or some cameras or IP or anything like that. We funded entrepreneurs against real estate they might have in other markets. We've worked with banks to procure guarantees, insurers to get wrappers. And all of these structures are the ways that we try to ensure that we can allow entrepreneurs to do their thing. So we're not the lenders that call them every single week being like, why has revenue gone down by 1%? And what's happening here and what's happening there, etc.
Sure.
We monitor stuff and information is crucial. But at some point, you have to believe that the person who set up the business knows how to run it better than you do. You're a provider of liquidity. You're a provider of growth capital. You're a partner. And so we see our role as providing all of that, while fundamentally, if you're to ask what our investment thesis is don't lose money, right? And I think you speak to any credit manager, they'll say the same thing.
That sounds like quite a lot of groundwork you have to do. We were chatting earlier and you talk about how much you've been traveling across Africa. Like, yeah, talking through that, the sort of level of work that's required even before you get to the point of signing, a contract.
Look, we're fortunate, and I think we have great senior partners, great management. We have a really awesome team. We have wonderful local partners. So in Ghana, Nigeria, Uganda, we have folks who sit on our board that we've known for 5, 10, 15. Zay might have known them for 20 years. Isha might have known them for 15 years. People that we've built deep, long relationships with who are on the ground. Because there is no way that you can run a sustainable and scalable strategy without having some sort of on-the-ground presence in these markets. So I think firstly, the most important thing that I'd highlight is that I think we have truly an extraordinary team, not only in terms of the folks who sit in our London and Lagos and Kampala and Tunisia offices, but actually our local advisors and our lawyers and all of these partnerships that we've built for a long time. A lot of our deals come through reverse inquiry, right? So because there are not that many options in town and you build a relationship and word of mouth, you have a lot of people coming to you. In terms of the groundwork you then build, I think our job, or the job of the investment team or the investment committee members, is effectively to understand, well, what's going on from a macro perspective, right? So capital controls, coups, political instability like Niger, Mali, Burkina. Is this good? Is this bad? Should we invest here? Should we not? So have that sort of 30,000 foot view. And then also when it comes down to the company level, I truly believe that it's a matter of just pattern recognition. And so what you see in Africa is that the big private equity firms may only do 2 or 3 deals a year. And this shocks people, right? When people come from they're doing banking at Rothschild or Lazard or Evercore, and they're doing deals every 6 weeks, and they go and they move to an emerging markets private equity fund. The number one thing you hear everyone say is like, deals take so long and we don't do many of them. At TLG, we've done 41 deals. We've exited 27 of them. And so our deal velocity and the frequency of the stuff that we do is actually, I think, way ahead of the rest of the market in terms of just getting stuff out there, deploying, looking. Our funnel at any one point in time, like right now, I myself, forget the rest of the team, I'm looking at 6 deals and everyone is looking at, a huge number of stuff. So I think we just find that by building reps and building pattern recognition, then it's like, okay, well, manufacturing, I've seen this before. Here's roughly what we look at. Here's the consultants that we liked working with. Here's the CEOs we can speak to. Here are the guys in Ghana, or Uganda, or Burkina Faso that I can call about it. And so I think, look, coverage is great and travel is good and travel's the fun part and you get to go to these amazing places. But actually it's the network, it's the team. And I think it's the shared experience of the individuals that make that team that allow us to do what we do.
Yeah. How do you ensure that you get your money back?
There are many ways. We were actually talking about this in the office today. And sort of Zaim, one of our colleagues, our CEO, had mentioned a quote from Theodore Roosevelt, speak softly, but carry a big stick. And I think that's very appropriate for credit, right? You never really want to enforce and go to court and like arbitration, you'll run out of money, right? You should not do that. Of course, you need to be able to do that. And you need to make sure where you're invested, you're secure. And if you need to do that, you can, and there is a liquidation value that allows you to return capital to your investors. But I think the real question is, when you're in that situation, why are you there? Is it because a central bank shut down access to FX and then the business, like all of their competitors, struggled? Is it because the company wound down because they were poorly managed? Is it because we're the sucker and we put too much debt onto a business that already had too much debt? The key is actually understanding why you're in that position, because it's never that straightforward. And I think the other thing that one of my former colleagues, Z, a Singaporean guy, used to always say is that you have ability to pay and you have willingness to pay. And those two are very discrete things and equally important. Because if someone has money, but they have other places they want to put it, then you're not going to get anything, right? But if there's a willingness to pay, sure, consider that restructuring plan. Look at extending the maturity, look at working with the business, etc. But we try to be in a situation where we're so aligned with other stakeholders that actually maybe they prefer to raise more equity. We like to be the bridge, the first capital in before they go to the institutions and the banks and so on, that actually will get refinanced out by a bigger fish down the line, because we're the ones that are the earlier partners that took the risk on that business and let them scale. But yeah, of course, it's credit. You need to have a good legal mindset. You need to understand how structures work. You need to know, at the end of the day, you're capping your upside, right? So you're not like equity where your shares can go to 1 billion. You're going to get paid your IRR. And so you need to look after the downside. But I think, it's not like the States where you're just, swearing on calls and shouting at people, going to court and all that kind of stuff. I mean, that doesn't really happen here.
Well, what's the typical duration of these deals?
So we try to hold our exposures for 5 to 7 years. It's also a function of the capital that we raise. So I think in the press in the next month or so, you'll see some really exciting news about the second fund that we're raising. And that has given us a little bit of, longer tenor capital to play with, which we're really excited about, because we can't wait to see our companies go that little bit further and grow that little bit more. But it's also a function of the capital you raise, right? So if your funds are slightly more open-ended, you need to be sensible with your asset liability matching. But yeah, I think we aim for 5 to 7 years, typically for our debt buckets, but we've done shorter stuff too. If it's a nice way to get exposure to a new sector or do a new deal, we try to be flexible with what the business needs.
Now, TLG, has supported companies in all kinds of sectors. I'm kind of curious to hear about your favorite deals. Maybe could you tell me one or two that you've really liked?
Sure. I mean, look, the one that I'm personally always love talking about is, I think I alluded to earlier, the sort of Nollywood financing that we did. Because I think it was the first media entertainment financing on the continent, especially in Nigeria, of its type. It happened in a market where there were issues with FX. There was a parallel rate. People were really not deploying into that industry. We worked with a really special entrepreneur, former private equity guy, had founded the business with 2 other sort of great folks. I remember the night before the first DD meeting, sitting in my hotel room in Victoria Island, trying to, watching a few of his films, being like, oh, this is cool. This is where our money's going. But I think that was awesome because we, and, my colleagues, especially Isha, who's one of the founding partners, sitting on the structure and trying out, how do we make this thing work was amazing. And that's the best part of the job, is putting the jigsaw pieces together, working with a great entrepreneur to do something that's never been done before. And a lot of our deals are the first structure ever of their type, especially to be done on the continent in Africa. So we're always trying to break boundaries. That keeps, the academic side of your brain going, because it's not the same documents every single time. And I think that one we really loved, not least because we actually managed to get a lot of investor interest from leading, European and American investors who liked the structure and wanted to participate. So yeah, that one was great.
Yeah. Do you think you likely have some other deal within that space, or did it really feel like a one-off?
No. So we're currently speaking to a few studios businesses who are doing stuff in East and West Africa. And I think more than anything, that helped us just with understanding that we're not, constrained to one type of sector. Because when you look at mid-market loans for 5 to 7 years, of course, manufacturing, healthcare, education, there are the core sectors that come to your mind. But I think what was amazing for that is we discovered a sector that you typically associate a little bit more with venture capital money, a little bit more with that kind of, sort of creative economy that may not be reconcilable with traditional finance. And we made it happen. But I mean, at the same time, a few months after that, we did a transaction with an aluminium recycler in Ota, Ogun State in Nigeria, 4 hours outside of Lagos. Beautiful business. They take scrap aluminium and sell ingots to Asia to make cars and all that kind of stuff. Right now, we're looking at a transaction in Djibouti. We're looking at one in Kenya. We just signed one in Ghana. So I think the team are really multidisciplinary in their approach, and it allows us, to do everything.
That's great. Just my last question. Looking ahead to the rest of 2025, what's one reason for optimism as you look at the African private credit space, and one reason for caution?
So optimism, I think there are actually many reasons to be optimistic. I think macro to some extent, and where this is being recorded, is maybe bottomed out. Can it get worse? Maybe not. Maybe you always get surprised, but these currencies have been in free fall. Policymakers are doing the right things. You're seeing central banks recapitalize the banking sector in Kenya, in Nigeria, in Ghana, which is really important because it brings in stability to the banking sector. I think you're seeing regime change, sometimes in very constructive ways. And so I think for a foreign investor coming into these markets, the biggest test for me is always to see what the local investors are doing. And in Nigeria, Guinness exited and Toleran bought it. And Heineken exited and a local guy bought it. And so when you see local entrepreneurs putting money into their pocket and allocating capital back into their markets to buy out a multinational corporation that maybe is scared because they've seen FX losses year after year after year after year, they're buying because there's equity value, and they will be there to create that equity value. And so for me, I think, especially for the patient capital investors, the holdco builders, the search funders, these kinds of guys, I think there's going to be a really wonderful time ahead for them because there are really great opportunities. There are sellers with fatigue who have seen it get worse and worse and can't even imagine it getting better. And you have stable macro here to support you. In terms of, the not so good stuff, look, obviously in the last few years, we saw a Zambia, a Ghana sort of sovereign situation. You see what's happening now in Mozambique and Kenya. There are, many of these markets, at least at the sovereign level, are arguably on the brink, and it's going to be really important to understand what finance ministers and policymakers do. And so I think the real risk that you see is a cascade effect, right? Where, part of the issue with Ghana is that you had people holding the local T-bills. There were loads of foreign investors holding T-bills. And so when they exit, they create a bunch of, they create a liquidity crisis and they have knock-on effects on the FX. And so I think it's really interesting because you're going to have to see whether policymakers want foreign investors in for the benefits they provide, or steer away from them and become more protectionist because of the instability they also bring. And on the one hand, you've got Ethiopia and Angola who are opening up, doing their stock exchanges, letting foreigners own their banks, etc. On the other hand, I think especially when you see what happened in Egypt last year, in Ghana and Zambia, etc., I think people are also, beware the guys from London and New York in their suits.
Sure. Yeah. Aum, really fascinating chat. I could go on and on, but we have to stop.
I'm sure we will as well, but I appreciate it, Chipo. It's been really wonderful speaking, and thank you so much for taking the time.
Yeah, absolute pleasure. Thank you so much.
All right. Cheers, mate.